Hey folks, it's Simo from Investment Research, and welcome to this monthly analysis for December. I'll be sharing my insights using real market data, including level 3 order flow, the same liquidity information that market makers and institutional desks rely on. I've prepared some important information in this video, so only if you find my analysis helpful, I invite you to like the video and subscribe if possible. Alright, from my perspective, we're heading into what's historically one of the strongest months for equities, but this December is shaping up to be anything but typical. We've got major volatility, critical Fed decisions, and some big technical setups that could determine whether we end the year with a bang or a whimper. So let's break down what's happening and what you need to watch. First, let's talk about where we are right now. The major indices have had a wild November. The S&P 500 and Dow finished the month barely in positive territory, while the Nasdaq took a hit, falling almost 2%. We saw significant pullbacks in big tech names, with the S&P dropping more than 6% from its record highs before staging a late month recovery. The market has been testing some critical support levels, and frankly, we're at a pivotal moment heading into December. Now, historically, December is the third best month of the year for both the Dow and S&P 500 since 1950. It's also the third best for the Nasdaq since 1971. We typically see what's called a year-end rally driven by a few factors. Fund managers who've underperformed all year often come off the sidelines in December, putting cash to work in a last-ditch effort to boost their returns and beat their benchmarks. There's also tax loss harvesting that happens mid-month, where investors sell losing positions and then that money often gets reinvested. Add in generally positive seasonal sentiment and you've got a recipe for upward momentum. But here's the thing, this December comes with some massive question marks that could override those seasonal tailwinds. The single biggest event is the Federal Reserve meeting on December 9th and 10th. This is not your typical Fed meeting. There's genuine uncertainty about what they're going to do, and even the Fed officials themselves seem divided. Let me explain why this matters so much. The Fed cut rates by a quarter point in both September and October, bringing the benchmark rate down to a range of 3.75 to 4%. Markets had been pricing in another quarter point cut in December as almost a sure thing, but recently that certainty has evaporated. As of right now, the probability of a December rate cut has dropped dramatically. Some measures put it around 40%, others closer to 80%, depending on which data you're looking at, but the point is there's real division. Why the uncertainty? It comes down to conflicting economic signals. On one hand, the labor market has been cooling. The Fed cut rates in September and October partly because job gains slowed and unemployment edged up, suggesting the economy needed support. Chair Powell has described it as a low-hire, low-fire environment. But then September's jobs report surprised everyone by coming in much stronger than expected, adding 119,000 jobs when forecasts were much lower. That threw cold water on the idea that the labor market is weakening enough to justify more cuts. On the other hand, inflation remains a concern. The consumer price index is still running near 3% year over year, well above the Fed's 2% target. Some Fed officials are worried that cutting rates further while inflation is still elevated could reignite price pressures. This is especially true given the strong consumer spending we're seeing and concerns about potential tariff impacts on prices. What makes this even more complicated is that the government shutdown earlier this year suspended a lot of economic data releases. The Fed has been operating with incomplete information, which Powell himself compared to driving in the fog. We're not getting the full picture on key metrics like retail sales and some employment data until after the December meeting. So the Fed is going to have to make a decision without all the usual data points they rely on. The minutes from the October Fed meeting revealed just how divided policymakers are. The language was unusually uncertain. Several participants thought another cut could be appropriate in December if the economy evolved as expected, but many participants, which in Fed speak means more than several, suggested it would be appropriate to keep rates unchanged for the rest of the year. When you see that kind of split, you know it's going to be a close call. So what does this mean for the market? If the Fed cuts rates in December, we could see a significant year-end melt-up in risk assets. Lower rates are generally bullish for stocks, especially growth stocks and rate-sensitive sectors. It would signal that the Fed is prioritizing growth and employment over inflation concerns, and that tends to boost investor confidence. We'd likely see strength across the board, particularly in technology, small caps, and sectors that have been under pressure. But if the Fed holds rates steady, the market reaction will depend entirely on the tone of the announcement and Powell's press conference. A hawkish hold where Powell emphasizes inflation concerns and suggests fewer cuts in 2026 could trigger a sell-off. Markets don't like surprises, and they really don't like the idea of higher for longer rates. On the other hand, if the Fed holds but signals that they're just pausing and will resume cuts in early 2026 if data supports it, markets might take that in stride. The updated dot plot that comes with the December meeting will be crucial. This is where Fed officials project where they think rates will be over the next few years. If the dots show fewer cuts than markets expect, that's bearish. If they show a path consistent with market expectations, that's neutral to bullish. This is one of those meetings where every word in the statement and every chart in the projections is going to be scrutinized. Beyond the Fed, let's talk about what's happening with the market itself. November saw some really interesting dynamics. Tech stocks, which had been the market's darlings, took a beating. Supermicrocomputer dropped 35%. Coinbase fell 21%. Nvidia, despite posting blowout earnings, saw investors take profits, and the stock pulled back over 12% for the month. The fact that the S&P 500 managed to stay positive despite Nvidia falling, that much tells you something important. The market is broadening out. For most of this year, returns have been concentrated in a handful of mega-cap tech names, the so-called Magnificent Seven. But in November, even as those names struggled, we saw strength in other areas. The market put together some very broad rally days, not led by the usual suspects. This is actually healthy. A narrow market where everything depends on 5 or 6 stocks is fragile. A broad market where leadership rotates and multiple sectors participate is more sustainable. Going into December, one of the key questions is whether this broadening continues. I believe we're entering a phase where stock picking becomes more important than just riding the index. The easy money of buying big tech and holding has gotten harder. Now you need to identify which companies are actually going to benefit from AI spending versus which ones are just riding the hype. I'm personally watching Microsoft and AMD closely as examples of companies that still look attractive even after the pullback, but I'm seeing more discrimination across the board. There's also growing concern about AI valuations, and honestly, I share some of these concerns. Hundreds of billions of dollars have been pledged to AI infrastructure investment. Companies are spending enormous amounts on data centers, chips, and AI development. The question I'm wrestling with, and I think every investor should be asking, is whether all this spending will actually generate profitable returns or if we're in a bubble. I see some parallels to the late 90s dot-com boom, where massive capital expenditures in telecom and internet infrastructure didn't translate to profits for many companies. But I also recognize that AI is different because it's already driving tangible productivity gains and revenue growth. This is why I'm being very selective about which AI plays I'm recommending. The technical picture is worth paying attention to, and I've been watching these levels closely. The S&P 500 broke below some key support levels in November before recovering. We're currently sitting around 6,800, well off the record highs near 6,900 from late October. Several technical indicators that I monitor triggered recently, suggesting we could be in a corrective phase. Based on my analysis, I think we could see a 10% pullback over the next 3 months, which would take the S&P down to around 6,200 or even lower. But here's where it gets interesting, and this is what my order flow data is showing me. Sentiment indicators show that investors are actually pretty cautious right now. Positioning data suggests institutions aren't heavily exposed to equities. When everyone's already bearish and sitting on cash, there's fuel for a rally because that cash can come back into the market. We've spent most of the year climbing what I call a wall of worry, and that's often when markets do best. If the Fed cuts in December and we get decent economic data, I expect all that sidelined cash to flood back in and push us to new highs. Let me talk about specific targets because I know that's what you want to hear. Wall Street strategists have put out their forecasts and they're all over the map. The median year-end target for the S&P 500 among major firms is around 6,000 to 6,200. Some forecasts go as high as 7,600 for 2026. My own target for year-end is 6,900 to 7,100, assuming we get a Fed cut. The bulls point to strong corporate earnings, the potential for more Fed cuts, and solid economic growth. I'm expecting earnings growth for the S&P 500 to be around 13%, which is robust. But I want to be honest with you, there are bears out there too, and some of their concerns are valid. Some analysts have slashed their targets significantly in recent weeks. HSBC cut their S&P forecast from 6,700 down to 5,600. Oppenheimer lowered their target from 7,100 to 5,950. These moves reflect concerns about tariffs, inflation, and the possibility of an economic slowdown or even recession. I'm not in that camp yet, but I'm watching these risks closely. Tariffs are definitely a wild card that I'm monitoring. The US has implemented significant tariffs this year, and the effective average tariff rate has jumped from 2% at the start of the year to nearly 12% now. Companies are navigating higher input costs, and there's uncertainty about whether additional tariffs are coming or if negotiations will lead to reductions. So far, corporate earnings have held up despite these headwinds. Companies have been able to pass costs along to consumers or find ways to absorb them. But if tariffs increase further, that could squeeze margins and hurt earnings. This is something I'm factoring into my sector recommendations. Another thing I'm watching closely in December is specific economic data releases. We've got some critical reports coming. Consumer spending data will be huge because it'll give the Fed insight into whether the economy is still running hot or cooling down. Strong spending would argue against a rate cut. Weak spending would argue for one. The jobs report for November, which comes out in mid-December, will also be important, though it'll be released after the Fed meeting, so it won't directly influence the December decision, but will set the tone for early 2026. Inflation data, particularly the CPI release, carries major implications for my thesis. A hotter than expected reading could send stocks tumbling and boost the dollar. A softer reading could kick off a renewed risk rally into year-end. I'm also preparing for tax loss selling in mid-December. Funds and individual investors sell underperforming stocks to lock in losses for tax purposes. This can create some temporary downward pressure and volatility, but I also see this as creating opportunities because once that selling is done, buyers step back in. There's also the mechanical flows that happen in late December. This is when annual bonuses get paid out, pension funds rebalance, and there's often a Santa Claus rally in the final week of the year. Historically, the last 5 trading days of December and the first 2 of January tend to be positive. It's a small sample size, but it's a real phenomenon that I pay attention to in my trading. Now, let me tell you what I'm watching sector-wise, because this is where I think the real opportunities are. Financials could benefit if rates stay higher or if the yield curve steepens. Banks make more money in a higher rate environment, at least on their lending side. I'm keeping an eye on some of the regional banks that have sold off significantly and might be oversold. Healthcare is particularly interesting to me right now because it's trading at relatively cheap valuations compared to the broader market. The forward PE ratio for healthcare stocks is significantly below the S&P 500 average, and I'm seeing some stalwarts like Pfizer and Johnson & Johnson at decade-low valuations with high dividend yields. In a market correction, defensive sectors like healthcare and consumer staples tend to hold up better, so I'm recommending clients add exposure here. Technology is obviously the big question mark, and this is where I'm being most selective. Information technology and communication services led the market in 2023 and 2024, and after a rough patch earlier in 2025, they've rebounded to again be top performers. But the concentration of gains in a few names and the questions about AI profitability make this sector risky. If you're overweight tech, I'm telling you that you need to be selective. Look for companies with actual revenue from AI, not just promises. Look for reasonable valuations and strong balance sheets. I'm personally trimming some of my mega cap tech exposure and rotating into more diversified plays. Small caps are another area I'm considering carefully. The Russell 2000 and S&P 600 small cap indices have underperformed large caps significantly this year. Small caps tend to be more sensitive to interest rates because they rely more on borrowing. If the Fed cuts and signals more cuts are coming, I believe small caps could outperform. But if rates stay elevated, they'll continue to struggle. I'm being cautious here and waiting for more clarity from the Fed before making aggressive moves. International markets are worth mentioning too, and I'm watching these developments closely. Japan's Nikkei had its worst November since 2011, falling over 4% for the month. The Bank of Japan is in a different position than the Fed. They're considering raising rates, not cutting them, because inflation in Japan has been persistently above target and the yen has been weak. A stronger yen and higher Japanese rates could attract capital away from US stocks, which is something I'm factoring into my allocations. China's markets have been volatile, though there's some optimism around economic stimulus measures. Europe continues to face growth challenges, with Germany in particular struggling. I'm underweight international right now, but I'm ready to adjust if we see meaningful policy changes. The US dollar's strength is another factor I'm tracking in my order flow. A strong dollar makes US exports more expensive and can hurt multinational companies' earnings when they convert foreign revenue back to dollars. We've seen the dollar strengthen recently, and if that continues, it's a headwind for earnings that I need to account for in my valuation models. Let me give you my base case for December and then some alternative scenarios, because I think it's important to plan for multiple outcomes. My base case is this. The Fed cuts rates by 25 basis points on December 10th. Powell strikes a balanced tone, acknowledging both inflation concerns and labor market cooling. He signals that further cuts in 2026 will be data dependent, but leaves the door open. Markets rally on the news, and I expect we'll see a year-end push toward new highs, with the S&P 500 ending December somewhere between 6,900 and 7,100. Breadth improves as the rally broadens beyond mega cap tech. Volatility remains elevated but manageable. This is my highest probability scenario, and I'm positioning my portfolio accordingly. My bullish scenario looks like this. The Fed cuts and provides dovish forward guidance, suggesting 2 or 3 more cuts in the first half of 2026. Economic data over the next few weeks shows cooling inflation and stable employment. Consumer spending during the holidays is strong but not overheated. We get a classic Santa Claus rally, with the S&P potentially pushing toward 7,200 or higher. Small caps and cyclicals outperform. The Nasdaq recovers strongly as concerns about AI spending prove overblown. If this scenario plays out, I'll be adding aggressively to growth stocks and small caps. My bearish scenario, which I'm giving about a 30% probability, is this. The Fed holds rates steady and strikes a hawkish tone. Powell emphasizes that inflation is still too high and that the labor market is stronger than feared. The dot plot shows fewer cuts in 2026 than markets expect. This disappoints investors who've been counting on easier monetary policy. I expect we'd see a December sell-off, with the S&P testing support around 6,200 or lower. High multiple tech stocks get hit particularly hard. Credit spreads widen, volatility spikes, year-end positioning turns defensive, and we head into 2026 with more uncertainty. If this happens, I'm ready to deploy cash into quality names at lower prices. There's also a wildcard scenario that I'm considering. What if we see a significant geopolitical event or an unexpected economic shock? Oil prices have been relatively stable but remain vulnerable to Middle East tensions. A spike in oil could reignite inflation fears. On the other hand, a breakthrough in trade negotiations that reduces tariffs could be very bullish. Political developments in Washington could also impact markets, particularly around fiscal policy and spending. I'm keeping some cash on the sidelines specifically to take advantage of unexpected opportunities. For those of you who are actively trading, here's what I'm thinking about and what I recommend you consider. This is a month where you need to be nimble. Don't get married to positions. I have a plan for both outcomes from the Fed, and you should too. If you're long and the market rallies after a cut, I'd consider taking some profits as we approach new highs because resistance at prior peaks can be strong. If we sell off, I'm looking for support levels where I want to add exposure. The key technical levels I'm watching on the S&P 500 are 67.68 on the upside and 65.30 on the downside. A break below 65.30 could fuel another leg down towards 6400, and I'd be a buyer at those levels. For longer term investors, I want to be clear about something. This volatility is probably noise. If you're investing for 5, 10 or 20 years, trying to time the market around a single Fed meeting is generally a mistake. What matters more is that you're diversified, that you own quality companies with sustainable competitive advantages, and that you're not overexposed to any single theme or sector. I've been doing this for years, and the market has a perfect track record of eventually moving to new highs over the long run. Every correction, every bear market has eventually been followed by new records. My advice for long-term investors is to stay the course and use any significant dips as buying opportunities. That said, I need to be honest with you about valuations. They're elevated by historical standards. The S&P 500's Shiller PE ratio, which looks at price relative to 10 years of earnings adjusted for inflation, is around 38. That's the third highest reading during a continuous bull market in over 150 years. The only times it's been higher were during the dot-com bubble and right before some other major downturns. High valuations don't tell me when a correction will happen, but they do tell me that forward returns might be more muted than what we've seen recently. This is why I'm being more selective and focusing on quality over momentum. Let me touch on the narrative around this bull market because I think it's important context. We're now 3 years into this run that started in late 2022. The gains have been impressive, driven initially by reopening trades post-pandemic, then by AI excitement, and throughout by resilient economic growth. But I want to remind you that bull markets don't die of old age. They die when something breaks. That could be a recession, a credit crisis, a policy mistake, or just valuations getting so stretched that there are no buyers left. Right now, I don't see obvious signs of an imminent break. The economy is still growing. Corporate earnings are solid. The banking system is healthy. Credit markets are functioning. Yes, we have some risks with inflation, labor markets and geopolitics, but nothing that screams crisis to me. What I see is more typical late cycle dynamics where growth is moderating, monetary policy is in transition, and markets are trying to figure out what's next. I'm not calling for a bear market, but I am saying we need to be more thoughtful about our positioning. December is going to be critical in shaping the setup for 2026. If we can get through this month with the Fed providing clarity, decent economic data, and markets holding key support levels, then I believe we could start the new year with positive momentum. If December disappoints with a hawkish Fed and continued weakness in tech, then I think we might be looking at a more challenging first quarter. Either way, I'll be here to guide you through it. Here's my specific advice for you. Stay informed. I'll be watching the Fed meeting carefully on December 10th, and I recommend you do too. Pay attention to the language in the statement and the dot plot. Listen to Powell's press conference. Watch how the market reacts in the hours and days after. I'll be monitoring economic data as it comes out. Keep an eye on breadth indicators and sector rotation. And most importantly, make sure your portfolio aligns with your risk tolerance and time horizon. If you're not sure, reach out to me or consult with a financial advisor. If you're tactical and can handle volatility, I think there might be opportunities to trade around these moves. I'm planning to be active in December, taking profits when we rally and adding on dips. If you're more conservative, I'd recommend trimming some winners, raising a little cash, and being patient. There's nothing wrong with waiting for better clarity. The best trades I've made in my career are usually the ones where I have conviction based on a clear catalyst, not the ones I'm forcing because I feel like I need to do something. In summary, December historically favors bulls, but this year comes with exceptional uncertainty around Fed policy, valuations, and economic trajectory. We could see a year-end rally that pushes us to new highs, or we could see a correction that sets up a tougher start to 2026. The next few weeks will tell me a lot about what kind of market we're in and where we're headed. I'm staying flexible, managing risk, and I'm not letting emotions drive my decisions. I recommend you do the same. Thanks for watching this December market analysis. I hope this gives you a framework for thinking about what's ahead and some actionable insights you can use. If you found this helpful, share it with other investors who might benefit. Make sure you're subscribed so you don't miss future updates. Good luck out there, and let's see how this month unfolds. I'll be back with more analysis as we get key data and developments. Trade safe.